So we'll start with the basics of technical analysis. And we are all aware that, we talk about there are majorly two participants in markets. One is bull and other one is bear. So what bulls are doing, they are going to push markets in its upward direction. They are going to increase the prices. And what bears are going to do, they are going to hammer down the prices. Okay. So these are two major participants, and so as long as bulls are very active, so market sentiment is positive, prices are going to go up, and we should be ideally part of that uptrend. Okay, and when there is a fear, the bears will start pushing prices down, and we might get an opportunity to buy stocks at lower prices, or we can create a short position that we can sell the stock first. Let's say you sell a stock at 100 rupees. Okay, now because bears are active and there's a fear in market, so prices are going to go down. So from 100 rupees, the prices are going to down to, let's say, 90 rupees. So as a bear view, what we can do is we can sell the stock at 100 rupees in the morning, and we can buy the stock at 90 rupees. Okay, so when the market settles down, as when the settlements are done after 3:30, so your buying is 90 rupees and your selling is 100 rupees. Okay, so with that as well, you have made a profit of 100 rupees. So that is, this concept is called as short selling. So when we short, so that is, we are selling first and we are buying later. Okay, and when we say I'm going long on a particular trade, so that is, I'm buying a stock. Okay, and maybe after a few days I'm going to sell that stock. Okay, and when we say intraday trade, so either we buy or sell first and then we reverse the trade. Okay, so that will be my intraday, because I'm not carrying over my position. Okay, why is that we overpay or underpay for a particular investment or for a particular stock? Okay, so sentiments is something that creates market forces. Okay, so when there is a greed, so everybody will want to buy a stock, and when there is a fear, everybody would want to sell their stocks. So it's not always fear and greed, it is making this kind of market moves. So when markets are rising up, okay, so there is a grid, plus there are less and less number of short positions, so there are less bears active, because they know that bulls are very strong, so prices are going to go up, we may not be able to bring prices down. So that is how the markets will rise. Okay, similarly, when there is absence of buying and very strong selling, so that is when markets will start to come down. Now there is other way, where bulls and bears are both active, okay, and they are just trying to buy and sell at the same time. So that is the case when markets will move sideways. So that phase is called as consolidation. Now this can be summarized with the normal demand and supply. So this is one beautiful example. So markets will go high, or the prices will increase. So an analogy or the example here is of milk. Okay, why milk prices are so high? Okay, there is a demand of milk because daily huge consumption of milk, but now there is no supply. Why? Because cows are missing. Okay, now there is no supply, so demand is bound to increase, and it will shoot up prices of milk. Okay, so very simple example here. So if we just understand this basic ratio, or the relationship between demand and supply, we'll get to know whether the bulls are strong or not. Alternatively, what we can do is try to understand what is the overall sentiment in the market. Okay, now we know that last week market has been going sideways. Okay, what does this mean? That bulls and bears both are active, and somehow the markets are going sideways. Now if we see the slight decline in terms of charts, what we can see that the gradually bears are getting active, and bulls are losing their interest in buying, because now they know that the prices are not going to go higher. So they'll prefer waiting, and they'll wait for the correction. Once the prices are coming down significantly, bull might enter the ring again, and then they'll start buying. Okay, so how exactly we decide on prices? Okay, so these are most active emotions in the market: fear and greed. Okay, and these are two important emotions which has been leading us to take a particular decision in all our buying and selling. Okay, so when prices rise, okay, so we usually think that I have missed out on this particular trend, and when the prices r- rise very sharply, which is usually the case, that the price usually rise very sharp, so that would be the grid would be acting on us, and we usually make a buy decision. And the moment we buy, we see that the market goes sideways for some time and it will start falling. Now here, the as markets start falling, the fear will take place, but we usually wait for some time, and we start losing out on our profit, or on the capital also. But what is happening over here is, we are sitting on a notional loss. Okay, it's not the actual loss. But what happens when the prices are trying to hit the rock bottom? So your fear will be maximum over here, and you'll think that the market is going to go more down, and you'll end up selling your scripts and you'll book your losses. Okay, and this is what the retailers has been doing. They buy when there is a maximum grid, and they sell when there is a maximum fear. Okay, and this repeats until they completely exhaust their capital from the market. And that is the reason it is said that 90% of the people lose money in the market. Okay, now why is that? Because of these wrong trading decisions. Most of the retailers, they don't study market, they just watch a ticker tape, they watch news channels or newspapers, and they become part of a campaign. Okay, so in any financial magazine or financial newspaper, everything, most of the time, everything that is said or a news is given is usually part of a campaign that is run by promoters or punters in the market, because they have a contraposition. They want stocks to move in their choice of direction. Okay, so certain news are spread in the markets. Okay, you must have received this incorrect rumors over WhatsApp, that a certain company is going to invest into XYZ company, and is going to increase the prices by XYZ amounts. And these are usually rumors, and these are operated news, and we usually become a victim of these kind of campaigns. So, as a technical analyst, our goal should be to rely on charts only, because charts won't lie. Charts will always tell you, it will capture overall sentiments of a particular stock, it will capture what has been going wrong in the company. It's also. So, charts is something that it's a single point of information that we can rely on, we can neglect everything else. So, in basics of price actions, so when we say price action, is basically change of price in a particular stock, okay, or in a particular investment instrument. Okay, so price movements or the changes in the price is called as price action. Okay, all the sentiments, whether it could be fear, greed, or any kind of sentiment, will always reflect in the price. Okay, because we know that we always overpay or underpay for a particular buying or during a particular buying or selling decision. Technical analysis or price action completely ignores fundamentals. What it believes is, whatever that is happening with a company, good or bad, what is going to change the price is the emotions. Okay, or what the bears and bulls are thinking about a particular company at a particular given time. They said tomorrow what is going to happen in the Infosys has nothing to do with what exactly the Infosys has been fundamentally doing. Okay, as I said, this knowledge can be applied everywhere. Price action helps you predict prices and trends. So psychological behavior and interpretations are always reflected in the prices. Okay, and we know that we always overpay or underpay for a particular investment instrument. So what are benefits of price action? It concentrates more on price. So we have very limited information that we need to analyze. It captures emotions, so we can quickly know that the bulls are active or not, or there's a fear or a greed. It can help us time our entry and exit. We might not be always correct in terms of entry or exit points, but it definitely helps. It relies on single important factor, that is price. So we'll talk about why or how price tricks our thinking. Okay, so here is one example of certain prices. Okay, so we're talking about mango prices over here. Okay, so let's say mango prices have been changing like this. So we just keep hearing numbers that certain person is selling mangoes at a certain rate. Okay, then after 2 days, 3 days, we might have some other price point, and this goes on for during the season of mangoes. Okay, now, so let's say on day one, you got an information that the mango price is, let's say, 50 rupees. Next day it goes to 70 rupees, and next day it goes to, on let's say fifth day, it goes to 100 rupees. Now, first day you might not feel the impact of this price increase, but from 50 to 100, when this happens in 5 days, we start to think that the price, the mangoes are now costlier, the price has increased significantly. So during this rise, so what are the things that what are the thoughts that will come into our mind? First one is that I should have bought yesterday, okay, or 2 or 3 days back, okay. Because we think that the price is costly, we'll start to think that maybe it's important that we should buy this particular mango or this particular item, because tomorrow the price might increase to 110, 150 or 200 rupees. Okay, so interestingly, let's say after 2 days the price drastically goes down to 40 rupees. So what we will think, okay, the prices has been cheaper, so we'll start to give a logic that maybe there is a huge supply of mangoes, and the mangoes are going to get bad in certain days. That is why they're sitting on a large inventory. That is why they are selling it at a lower price, and we might not buy when the prices goes down further. Okay, so if you notice, throughout these price fluctuations, has there been any change in the mango itself? Okay, there's hardly any change in the mangoes, because mangoes are going to be yellow, and maybe those in case you chose the right mangoes, those will be sweet. So fundamentally nothing changes with the mangoes. Okay, but let's say we as a trader who are going to buy or sell mangoes, okay, let's say we buy at let's say 50 rupees. Okay, we buy here. Okay, and let's say we sell mangoes at 100 rupees. We have made a profit of 100% over here. Okay, and let's say you short sell, or let's say you sell more mangoes at, though you had, let's say, 100 mangoes, you sell 200 mangoes over here. So you have created a short position in the morning itself, and then you buy at 40. So you have made additional profit of 60 rupees over here. Okay, so as a trend analysis, when you draw a chart of multiple prices, as a trader, you'll understand whether I should be buying or selling at a particular price point. Now, working on 5 or 6, or maybe let's say 2 or 3 data points is relatively easy. But what happens in markets, there are constant fluctuations in market price of a particular script. So almost every second the prices are changing. So you can assume in the 6 or 7 hours of trading, how many different price points would be there, which you'll have to take care of. So in a way, this is not possible to track. So what we usually do is we tend to work on random price points like this. Let's say 50 rupees, and again let's say 23 rupees, and let's say there's some very tricky. So here we are going to talk about the candlesticks patterns, which can help us analyze these particular price movements very efficiently. Okay, before we start with that, always remember that the stock market is a negative sum game. Okay, so when I take a trade, okay, what are the chances that I'm going to either win or I'm going to lose in a particular trade? Okay, so whether I win or lose, okay, there is certain amount of portion that I need to give to my broker. Okay, or there is a CDSL fees, taxes, and in the broker's margin or his commissions. So let's say you buy at 100 rupees and you sell stock at 100 rupees. So for us, we think that it's a I did not made any profit or loss in this particular trade. However, you'll see your end of the statement as 99 rupees in your capital. Okay, why? Because somehow 1% approximately has been paid to brokers, CDSL, and taxes. Okay, so that is why the stock market is negative sum game. So that is the reason it makes more harder win in the stock market. So the moment you take the trade, it has to, let's say, go to 101 or 102. That is how you'll turn your capital into profits. So this is always important that we are sure that the moment we take a trade, we are open to make losses the moment we take the trade. And if we win, of course, this is not going to matter much. Let's say you make a profit of, let's say, 30%, or let's say even 10%. So we are happy to give 1% to brokers, CDSL, and taxes. Okay. But it's important factor that we should be aware of this, especially when you're going to work on very large position sizing. Let's say you're going to buy a script for, let's say, 10 lakh worth of shares. So that would be a significant quantity, and the charges in terms of brokers and the taxes, everything would be really high.